West Pharmaceutical Services, ticker WST, just dropped their Q2 2026 earnings, and management is officially stating they exceeded expectations. I mean, they absolutely beat consensus across the board.
Yeah, it was a massive beat.
Okay. So let's just get straight to the numbers. Net sales for the second quarter came in at $872.3 million.
Yeah.
That is up 13.8% on a reported basis.
And, 12.7% organically, which is just huge.
Exactly. But the real headline here, honestly, is the bottom line. Q2 adjusted diluted EPS hit $2.37.
Which is a massive 28.8% jump year over year.
Yeah, it's wild. And management is carrying that momentum forward. They raised full-year 2026 revenue guidance to a range of $3.345 billion to $3.380 billion.
Plus, the full-year adjusted EPS guidance got a nice bump too, right?
It did, yeah. It's now sitting at $885 to $9.05. And finally, they introduced Q3 guidance, forecasting revenue of $820 million to $835 million, with an adjusted EPS of $2.14 to $2.24.
So it's just a highly leveraged beat on the bottom line. Anytime you see EPS growing, more than twice as fast as the top line, you're looking at a serious margin expansion story playing out under the hood.
Right. So today we're taking a deep dive into WST's Q2 earnings print, the accompanying management commentary, and a whole stack of industry regulatory notes to answer one core question for you.
Yeah.
How exactly does a pharmaceutical packaging company expand margins this aggressively in what is basically a mature industry? Like, what is driving this kind of profitability?
It fundamentally comes down to a very intentional shift in their product mix. If you look at their margin profile this quarter, gross margin expanded by 200 basis points to 37.7%.
Wait, 200 basis points?
Yeah, 200. And their adjusted operating profit margin jumped an incredible 230 basis points to reach 22.6%.
That's incredible.
Right. I mean, in the manufacturing and primary packaging space, finding over 200 basis points of operating margin expansion in a single year is a massive structural shift.
Well, you don't just stumble into those kinds of margins. To understand the mechanics of it, I think we have to pull apart their proprietary products segment, because that is where all the heavy lifting is happening.
Definitely.
That segment brought in $722.6 million, up 16.6% year over year. But looking through the sources, when you break that segment down into its subcategories, the growth rates are wildly divergent.
They really are. Inside proprietary products, you have three main buckets. First, you've got high-value product components, what they call HVP.
Yeah.
That generated $424.1 million, growing over 19%. Second, you have HVP delivery devices, bringing in $131.2 million, and that was growing at almost 30%.
Wow, 30%.
Yeah. And finally, you have the standard products bucket. That brought in $167.3 million, but it only grew 2.4%.
Okay, looking at those numbers, it feels a lot like analyzing, a sauce company, like one that is successfully migrating its legacy user base from a basic free tier up to a premium enterprise tier.
That's actually a pretty good way to look at it.
Right. The standard components, like the basic containment products, they are essentially the freemium model. They get WST in the door. But the real rocket fuel for the bottom line happens when they convert those exact same customers over to the HVP side.
Yeah, the sauce analogy holds up perfectly when you look at the financials, but the physical reality of the business is far more rigid. I mean, standard components do have a slow growth rate, but they represent an enormous installed base.
Right, they've been selling them forever.
Exactly. So the margin expansion happens because WST has successfully engineered a pathway to force those legacy customers upward. The high-value products carry significantly higher gross margins because they involve intense advanced processing.
Like what kind of processing?
We're talking about special coatings like Fluorotec and advanced wash processes like Envision.
I want to stop you right there, actually, because the earnings transcript throws around terms like Fluorotec and Envision constantly.
That's nonstop.
From a technical standpoint, what do those actually do? Because to a layman, or even just an investor looking at a spreadsheet, a rubber stopper for a medicine vial is just a rubber stopper.
Mm-hmm.
Why is a pharmaceutical company paying a massive premium for an advanced wash?
It has to do with the chemical reality of storing liquid drugs for months or, even years at a time. Standard rubber stoppers are porous. Over time, the chemical compounds in the raw rubber can literally leach out into the drug inside the vial.
Oh, wow.
Yeah, it's called leachables and extractables in the industry. Or, conversely, the active ingredients in the drug can get absorbed into the rubber itself.
Which obviously you don't want.
No, absolutely not. Either way, the drug's efficacy is compromised. So Fluorotec is basically a specialized fluoropolymer film. Think of it as a a microscopic layer of high-tech Teflon that's applied directly to the stopper.
Okay, so it seals it.
Exactly. It creates an impermeable barrier between the drug and the rubber.
So it guarantees the drug remains chemically pure while just, sitting on a pharmacy shelf.
Mhm.
And what about the Envision wash?
The Envision process is a vision inspection and specialized washing protocol. It guarantees an incredibly low level of particulate contamination.
Particulate contamination,
Yeah.
like
Yeah.
dust.
Basically, yeah. When you're dealing with highly sensitive drugs, even a microscopic speck of dust or like silicone oil on the stopper can cause the drug's proteins to aggregate and just fail.
Oh, I see.
So WST uses machine vision and this proprietary washing to essentially guarantee a near zero defect rate.
That totally clarifies the value proposition. But it brings me to my next question. Why the sudden rush? A near 20% jump in HVP components means their clients are feeling an intense urgency to upgrade to this premium tier right now. What is the catalyst?
The urgency is coming almost entirely from the biologics market, and specifically the absolute boom in GLP-1 weight loss and diabetes drugs.
Of course, GLP-1s.
Yep. If you want to understand WST's growth trajectory, just look at the market group breakdown. Biologics now make up 43% of WST's total sales, and that category is growing at a blistering 30.3% year over year.
30.3% growth on a segment that represents nearly half their entire business.
It's massive.
That is staggering.
Yeah.
Especially when you compare it to the rest of the pie.
Mm.
Like traditional pharma is 24% of sales, and it only grew 3.3%.
Right.
And generics is 16% of sales, growing 6.9%. So biologics is completely hijacking the growth narrative here.
Exactly. And the reason biologics require those fluorotech and Envision components we just talked about is because of their physical structure.
How so?
Well, traditional pharma drugs, think of like an aspirin. They're small molecule chemical compounds. They are incredibly stable. You can stick them in a cheap blister pack and they are fine for years.
Right.
Biologics, however, are large molecule proteins. They're often derived from living cells. So they are incredibly complex, highly unstable, and very, very sensitive to their environment.
So if a biologic drug touches a standard uncoated rubber stopper,
It degrades rapidly. The proteins can literally unfold or bind to the raw rubber. Yeah, that is why the transition to biologics automatically forces a transition to high-value products. You have no choice. And within biologics, the GLP-1 tailwind is the single biggest engine. Management noted that GLP-1s are their fastest growing category, representing 18% of WST's total net sales right now.
that 18% breaks down pretty interestingly too, looking at the notes. 10% is coming from elastomers, which are the stoppers and plungers inside the injector pens, right?
Correct.
And the other 8% is coming from West Vantage products. So they are attacking the GLP-1 supply chain from multiple angles. But here's where I'm kind of hung up, reading through management's commentary.
What's that?
The sheer scale is just mind-boggling. They mentioned a roughly 6 billion component potential opportunity out there just to upgrade quality levels for these new GLP-1 drugs.
Yeah, that is a staggering volume of highly specialized manufacturing.
Right. So if demand is this high for the hottest drug category in the world, aren't they facing a severe capacity bottleneck? I mean, you can't just flip a switch and 3D print a billion FDA-grade fluorotech stoppers. How are they physically keeping up without breaking their own supply chain?
It is the existential question for literally any hardware or manufacturing company in a hyper-growth phase.
Yeah.
The answer is entirely in their capital allocation strategy. They are aggressively retooling the business, pouring cash into their CapEx plans to build out these highly specialized production lines.
Okay, let's look at how they're funding that. Because in the first half of 2026, their operating cash flow was $213.9 million, and free cash flow was $128 million. Yeah. Yet management is guiding for a full-year CapEx spend of between $250 million and $275 million.
It's a very heavy spend, but you have to look at exactly where those dollars are going. Management explicitly stated that CapEx is heavily aligned toward HVP processing capabilities and GLP-1 capacity.
So not just building empty warehouses.
Yeah, exactly. They aren't building generic factories. They are building the specific high-margin production lines that are driving the margin expansion we talked about earlier. And beyond just GLP-1s, there is another major structural catalyst driving this CapEx that practically guarantees demand.
Okay, what's that?
It's called Annex 1.
Ah, I saw Annex 1 mentioned multiple times in the earnings call notes. How does a European regulatory framework force packaging upgrades on a global scale?
So Annex 1 is a revised European regulation focusing on the sterile manufacturing of medicinal products. Basically, it raises the bar for contamination control to a level the industry hasn't really seen before.
Okay.
It mandates that pharmaceutical companies implement a comprehensive contamination control strategy, or CCS. In practical terms, this means they can no longer use basic packaging for sensitive drugs because the risk of particulate contamination is just deemed too high under the new rules.
So let me get this straight. If a company wants to sell its drug in Europe, they are practically mandated by law to upgrade to the high-value, heavily washed and coated components that WST provides.
Precisely. And because pharmaceutical supply chains are global, a major manufacturer isn't going to run two separate packaging lines.
Right. They aren't going to have a cheap one for the U.S. and an expensive one for Europe.
No, it's too complicated. They just upgrade the whole system to meet the strictest standard. Management actually expects Annex 1 and this resulting HVP conversion to drive 200 basis points of contribution to revenue growth for the full fiscal year 2026.
Wow. That actually makes the massive CapEx spend look significantly de-risked. They're building capacity for a market where demand is effectively guaranteed by international law.
It's a pretty nice position to be in.
But here is the piece of their capital allocation that really caught my eye. Despite guiding for up to $275 million in CapEx, they're still aggressively returning capital to shareholders. Like in the first half of the year, WST repurchased 1.8 million shares for $454.3 million.
Yeah, and if you run the math on that, the average price comes out to around $258 per share. Think about the signal that sends.
It's huge confidence.
Right. When a management team authorizes a near $500 million share repurchase in a 6-month window, while simultaneously executing a massive CapEx cycle to capture a $6 billion component GLP-1 opportunity, it signals extreme confidence in their forward-looking free cash flow.
They aren't hoarding cash.
No, they are deploying it because they know the returns on invested capital are expanding rapidly.
It is such an aggressive balancing act. And honestly, it gets even more fascinating when you look at what they are shedding to make this happen.
You mean the divestiture?
Yeah. Mid-year, they executed the strategic sale of their Smart Dose 3.5 L-liter on-body delivery system to AbbVie.
Which is a crucial modeling detail for anyone looking at their forward revenues, by the way. Management noted that this divestiture removes $55 million of expected revenue from the second half of 2025 from their organic growth baseline.
Right.
It was a $30 million run rate in Q3 of last year and $25 million in Q4.
It kind of reminds me of like a wildly successful restaurant group selling off its highly profitable, massive delivery fleet.
Okay, I see where you're going with this.
Like, the delivery business makes money, sure, but managing drivers is a logistical headache that distracts the executive chef. So they sell the fleet to a third-party logistics company, take the cash, and invest every single dollar into expanding the kitchen of their Michelin star flagship restaurant. Because that is where the margins are astronomical.
I like that analogy a lot. You divest the non-core asset, take the capital from the sale, pair it with your strong operating cash flows, and just ruthlessly funnel it into the highest margin, fastest growing segment of the business.
Exactly.
The Smart Dose platform is impressive technology, but if managing it distracts WST from capturing an outsized share of this once-in-a-generation GLP-1 boom, it makes perfect strategic sense to hand it over to a partner like AbbVie. Then WST can focus entirely on their core HVP manufacturing engine.
So if you are a retail investor listening to this and trying to value WST's long-term position, what does this actually mean for your portfolio? We've covered the top-line growth, the margin expansion, the biologics tailwinds, the regulatory push from Annex 1, and their ruthless capital allocation. But what is the bedrock here? Like, what is stopping a massive, well-funded competitor from just spinning up a factory, buying some fluoropolymer coating machines, and undercutting them entirely?
This is where we have to connect everything back to the concept of an economic moat. And ironically, the most impenetrable part of WST's moat isn't actually the high-flying GLP-1 components.
It's not.
No, it is that slow-growing standard components business we mentioned at the very beginning of this deep dive, the one that's only growing at 2.4%.
Wait, the freemium tier? The basic stoppers?
Right. That standard components segment is the hidden weapon of the entire enterprise, because these basic primary containment products are literally spec'd into the pharmaceutical customers' FDA-approved manufacturing processes.
Specced in. Break that down. What does being specced in actually mean in an FDA context?
So, when a pharma company gets a drug approved by the FDA, they aren't just submitting the chemical formula of the drug for approval, they're submitting the entire manufacturing and packaging ecosystem.
Oh, I see.
The FDA approves the specific glass vial, the specific West Pharmaceutical stopper, the specific aluminum seal, all of it.
The entire physical supply chain is part of the approval.
Yes, exactly. So, if that pharma company suddenly decides they want to switch to a cheaper competitor stopper just to save a few pennies per unit, they can't just swap it out.
We have to reapply.
They often have to go through a rigorous, incredibly expensive, and extremely time-consuming requalification process with the FDA. And they have to prove scientifically that the new stopper doesn't impact the drug's safety or efficacy.
So the switching costs are astronomically high. The risk-reward for a pharma company to disrupt the packaging of an approved cash-flowing drug to save a marginal amount on a rubber stopper just makes zero sense.
Exactly. It creates an entrenched, highly sticky business funnel. Once WST is designed into a drug's packaging, they are typically in for the entire life cycle of that drug, which can be decades.
Decades, wow.
Yeah. And from that incredibly stable base, WST can continually upsell those customers to the HVP components over time as new generations of drugs are developed, or as regulations like Annex 1 literally force their hand.
Right.
Furthermore, you have the macro trend of nearshoring. Pharmaceutical companies aggressively wanting their supply chains closer to home and more resilient after the disruptions of the past few years. WST's massive global manufacturing footprint makes them the safest default choice, which widens that moat even further.
It is essentially the ultimate captive audience.
Yeah.
You get written into the FDA approval documents, and then you just patiently wait for the regulatory environment or the complexity of biologics to force the upgrade cycle, knowing your client literally has nowhere else to go.
Yep.
It completely explains the margin expansion, the aggressive share buybacks, and why management felt confident enough to raise guidance this quarter.
It is a textbook example of leveraging a structural advantage into compounding profitability.
But it leaves you with a really provocative thought to consider going forward. If WST's components are this absolutely vital to the biologics and GLP-1 supply chain, and the switching costs are basically insurmountable, are we approaching a future where pharma companies try to vertically integrate?
That's a great question.
Right. I mean, if you are a Novo Nordisk or an Eli Lilly making tens of billions on these weight loss drugs, at what point does it make strategic sense to just buy a specialized packaging manufacturer entirely, just to guarantee your own supply lines and lock your competitors out of the premium components?
It is an incredibly valid point, especially as supply chains become the primary bottleneck for these mega blockbuster drugs. The value of controlling the physical packaging is only going up.
And that is exactly the kind of market dynamic we will be keeping a close eye on. To catch our ongoing analysis of shifting supply chains, margin expansions, and the structural forces driving the market, make sure you hit follow or subscribe on your platform of choice for our daily, no-nonsense earnings coverage.